Hello, everybody, and welcome back. Today, we look at a totally different investment angle in Asia. Pictet is taking an event-based approach with its new Lotus strategy. Today, we talk about what that means with Jon Withaar, head of Asian Special Situations and the lead portfolio manager of the Lotus fund at Pictet Asset Management. Welcome, Jon.
Thank you very much for having me. I appreciate the time.
Jon, why don't you explain your investment approach in 3 sentences to our audience?
Ooh, 3 sentences, a little bit tough. But ultimately, we're a strategy that really is non-directional, and where we profit is on situations whereby we see corporate change and corporate events. So we're looking at, deriving alpha from corporate transactions, whether it's mergers, whether it's spin-offs, whether it's some type of other corporate activity. And as a result, we're not really dependent on the direction of the market to derive alpha, which I imagine is a point of interest in these current conditions.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now.
So what is the special challenge of such an investment approach?
I mean, look, ultimately, we are children of our environment. So we need corporate activity to be taking place. We need those consolidation events. We need the M&A. We need the sell downs. We need corporate boards to be making decisions to improve their businesses, or we need distressed situations. So we just need those transactions. But ultimately, as I said, we're not so dependent on the direction of the market. But as long as the markets are functioning properly, and as long as corporates are doing things and directors are making decisions, then generally we find there's ways to derive alpha.
So events like M&A seem to be hard to predict. So how do you forecast those situations, and how do you manage this kind of uncertainty in your strategy?
It's a tremendous question. So ultimately, yes, you're right. They are somewhat hard to forecast. They are quite hard to forecast. But ultimately, what we're looking to do is not necessarily spend the majority of our time forecasting, but we're trying to spend our time around the probability of these things taking place. So ultimately, you may have a situation where one company is buying another for 100 yen. This will trade at generally 900 yen or below that level to reflect that uncertainty. So where we spend a lot of our time is building our investment case around the certainty of that transaction taking place. And these are all idiosyncratic drivers. So these may be things, for example, antitrust risk. It may be financing regulations. It may be all sorts of different approvals that are required for that transaction to take place. So we spend a lot of our time there and the minutiae of the details and a lot of legal documents, understanding the framework of that agreement and the environment to build an investment case around the probability of that 900 yen becoming 1,000 yen and us collecting that risk premium. And ultimately, the goal is to just continually cycle that risk premium through the portfolio over and over again. And then as we sort of take a step backwards, we apply this same methodology throughout the various other types of situations that we see in the Asian region. So, for example, we see value being created in a spin-off or a special dividend, a particularly large buyback, all these kinds of things. We spend time triangulating not only the value, we also spend our time triangulating the probability that such a thing will happen or may not happen. And then we also spend a lot of time, if required, on hedging as well.
Why should investors utilize a long-short strategy in Asian markets? And why do you think is it superior to traditional managed long-only mutual funds?
It's a very, very good question. And ultimately, it's actually quite simple to answer, though. And, the Asian markets are very volatile, and perpetual performance is not given, for example, the way it is in the US and the S&P 500. So if we use the Hang Seng index as a simple example, right now, that index is trading where it was in 2010, which means that you invested 13 years ago, you've not made any money on an outright index basis. Similarly, if you take Japan, if you look at the Nikkei index, that has only just recaptured the levels that it last saw in 1990 and was in a sideways to bear market, if you will, over 25 years. And so these markets are much more complex. They're not, this value creation aspect is not particularly given. And so really you need to have experts there that understand not only the regional nuances and the regulations, but also that markets just don't go up in a linear fashion in Asia. There's a lot more volatility. There's a lot of uncertainty. As we've seen, there's a lot of geopolitical concerns as well. And therefore, long-short strategies can, I guess, utilize those kinds of events and those kinds of situations without necessarily being directional. So regardless of the direction of the market, a long-short strategy should be able to derive alpha through the cycle. And that's really what we're aiming to do.
So fixed income is back with the rising interest levels. So how does your long short bond fund provide better returns over bonds in the current high interest and rising interest rate environment?
It's certainly a challenge, but the way that we look at that is we tend to find that our spreads in our universe actually expand alongside those bond rates, and many of the situations that we're involved in actually have to be financed with capital, obviously, and so there is a link between what the cost of capital is and where the spreads are trading. And so for us, it's helpful to us because it helps the spreads widen and make our opportunity set a little bit wider. But look, ultimately, the bond market itself, whilst bonds have improved and have widened, there's challenges as you've seen there as well. And there's just plenty of volatility in that market as opposed to just being straight outright long. So, we think as a complementary investment to what we're doing, we certainly think that there's a sensible investment professional uses all the tools that they have in their available tool chest, and we view ourselves as one tool of a number of tools, I guess.
What are the main skills that you have to bring to the table as an asset manager to successfully manage a long-short, event-driven strategy like that?
I think there's a couple of things. I think the first and foremost thing that's important for any manager of money is an understanding of risk. And that goes to whether you're trading a bond fund, whether you're trading a long-only fund, whether you're trading a long-short fund, an event-driven fund, whatever. Ultimately, how you size your position, what you do when things are going wrong, what you do when things are going right, how you hedge things, all these things play very, very, very central role into how a fund should perform and what a fund should be doing in certain market conditions. And so we take a very, very deep approach towards the way that we construct our portfolios. We certainly spend a lot of time on risk. And we think that's core to the way that any money manager should be looking at it. Now, when it comes to the Asian region, there's a whole other skill set that you have to, I guess, learn over time because it's such a diverse region. We have many different languages, many different cultures, many different regulators, and we have many different geopolitical relationships, whether it's Korea and China, Japan and China, China and the US. All of these things are very, very different, and they all inform the investment landscape differently as well. These things are often just learnt through experience. You can't just pick up a book and understand this straight away. And so experience is also very, very key in investing in this region. That's something that we've spent a lot of time doing. I myself have been doing this in the region for 23 years now. And certainly that we view that as being very invaluable, particularly in these kinds of markets.
So how do you identify potential long-short investment opportunities in Asia? How does it work?
So ultimately, we're looking from a very specific universe, and that universe is that corporate activity universe. So we have the benefit of looking at, for the most part, things that are already announced. So a company announces a takeover or a sales process. A company, for example, we saw a very, very high-profile sales process moving towards its resolution with Toshiba in Japan overnight. Those kinds of things are very interesting to us because they're announced. And then we can from there look at the announcement, whether it's some kind of a takeover or a merger or a spin-off or some kind of other corporate activity. We can look at that activity. We can then try and derive what the value to be extracted is. We can try and derive the time horizon, which is generally fixed. And then we can try and work on a hedge if it's required as well. And so, we're really looking at that announced universe of situations and all that corporate activity that's coming to help fill out our landscape. And, the interesting point is if you take that landscape in general, it's only going one way. It's only going up. Historically, Asia has been less than 15% of global transaction volumes in terms of corporate activity. We're now close to a third. Southeast Asia last year did an all-time high, did 3 times its long-term average, and that's despite the market conditions. So, it's an exciting place to be out here in Asia, and certainly there's a lot to do.
Currently, corporate profits are coming under pressure due to the tough macroeconomic conditions. So how does this impact your potential investment universe and your strategy?
That's also a great question. And we are, for the most part, not a fundamental long-short strategy in the sense that we're not trying to predict earnings. We're not doing forecasts, any of this kind of thing. Where we're spending our time is around those transactions. So insofar as those earnings or the environment will inform some kind of a transaction, it's obviously something that has an impact. But ultimately, when we're looking at our universe, we're not looking at those earnings. We'll take them into account, but we're really looking at that transaction. What does that transaction mean for the corporates, both of them involved? Is it creating value? Is it destroying value? If it's destroying value, we're happy to be short. If we're creating value, then we're happy to be long. So we are directionally agnostic. And ultimately, we're really just trying to focus on that universe. Now, as the macroeconomic conditions deteriorate, this does mean things for corporates in the region. Obviously, we tend to see through this part of the cycle more M&A, particularly strategic M&A. We also tend to see more restructures, whether it's spin-offs, whether it's asset purchases, perhaps, whether it's distressed situations. We see more of those as the cycle turns and goes worse as well. So you may get distressed equity raisings as companies can no longer raise money from the debt markets. So it's still very, very good hunting ground in these kinds of conditions. And then particularly for those investors that are not directional like us.
Can you give us some examples of recent investments you did or some long-short pairings that you did in your portfolio?
So, without going into specific names, one of the bigger trades that we have in our portfolio at the moment is a trade that's focused around buybacks and capital returns in Japan. So one of the themes that we've noticed in Japan over the last number of years has been, since the impact of the corporate governance code, in fact, has been an increase in the prevalence of Japanese companies both returning capital through buybacks, but also through raising their dividends. So one thing you may not know is that Japanese corporates have the strongest balance sheets in the world, in fact. They're very, very well capitalized. And this is a hangover from, I guess, the 90s and the crisis period there. So they're very, very well capitalized. But what we saw during the Abenomics years was the introduction of the corporate governance code, which really was a framework that set out ways for the Japanese market, Japanese equities to move into the 21st century. So it was a really concerted push to increase things like ROE, to increase things like corporate governance and have an improvement there, and overall oversight and also shareholder engagement. But what we've seen since then is that companies have really engaged with shareholders more. So we've seen more activism, but we've seen companies also very much focus on returning capital to shareholders and bringing up their ROE, as I said, either by buyback or by increasing their dividend. So what we have a model that positions us for companies that are announcing buybacks or in the position to announce buybacks, may have announced them in the past and have the ability to announce them in the future. Also companies that have the ability to raise dividends. So we're trying to hone in on those specific catalysts and those specific events. And then we screen the market for those particular names. And then we have a fully hedged basket on either side that effectively offsets that. And so what have we got in that situation? We have a basket of long names that are announcing buybacks, increasing their dividends, or at least paying some kind of a dividend to investors over time. And then on the other side of that, we have companies that are not. And that's an example of a way that we would look at sort of positioning in this kind of a market where we have no directionality in the market, but the exposure that we do have is to companies that are positively impacting change for their investors, but are also obviously very well run because they're doing these buybacks, they're paying these dividends, and they're clearly making money to be able to do this.
So this was Jon Withaar from Pictet Asset Management. Thank you very much, Jon, for being with us today and sharing your insights into investing with an event-driven angle in Asia. Thanks a lot.
Thank you very much.